Welcome to the Cincinnati Real Estate Investing Show. I'm your host, Slocum Reed, joined by our co-host, Ian Cruz, and our guest this week, Dylan Koch. Dylan has been investing in Cincinnati for 8-9 years now. He started Morning Brew Properties in 2021, which is primarily a direct-to-seller marketing and wholesaling company, but it has also gotten him a rental portfolio of 50 units in the last 5 years, all from his own direct-to-seller marketing while flipping some and wholesaling many others. Dylan, glad to have you here. Good to be having this conversation with you to add value to people who want to know about investing in Cincinnati in 2026. Tell us your Cincinnati story. How did you land here and how did you get into real estate investing?
I moved down to Cincinnati in 2011. I went to the University of Cincinnati to pursue a degree in pharmacy, get my doctorate of pharmacy, which I ended up doing in 6 years. So then I graduated from UC in 2017. And then I met my wife in pharmacy school. She is a Cincinnati local in the Westchester area. And so I married her. She wants to stay. We're staying. It's pretty much the synopsis there.
Yeah, that's what happens to everybody who marries a girl from Cincinnati.
Yeah. To be fair, I love Cincinnati. It has treated me very well, and I do love the city. So it was a mutual decision.
Yeah. And what got you into real estate from pharmacy?
When I was graduating pharmacy school, which is 2017, and you go into the world, I worked for Kroger at the time. And at the beginning, you're a floater pharmacist. Basically, you just go to where they need you. And the thought process was, I'm going to make decent money. I should know what to do with that money. So just started digesting everything that I could, all the way from Dave Ramsey to Robert Kiyosaki, Brandon Turner, and Bigger Pockets. And so I learned about house hacking. Someone in my gym was a realtor. And so in June of 2018, I bought a duplex in Oakley. And that was simply to reduce my expenses so I could pay off my student loans faster.
And what led to you going full time?
So between when I graduated 2017 into 2021, it was a mixture of changing jobs, being manager, working a ton of overtime, and got herself in a position where I was able to pay off our loans. I got married or I was engaged actually in that time frame. And me and my wife were kind of sitting around, and pharmacy, at least for me, was not fulfilling. You are plateaued on your earning income at a young age. In that education space, I learned that real estate was probably my best avenue to generate wealth for me and my family. So when I got closer to it, I was in a new job. We had some money saved up. We didn't have kids yet. So I just basically went to my wife and said, hey, I'm going to try to do this. If it doesn't work, I'll just go back to being a pharmacist. And then we had some experience up to that point with direct to seller, different avenues, different partnerships. And so I left in, I think it was technically October of 2021 with the intent of, one, buying more rentals because we were at zero at that point, but two, creating some business from wholesaling and flipping to offset the pharmacy income, create more money, and honestly just build wealth that way. And it took, I'll share this now, I had spent about 30 grand and didn't do a deal. I was like, I'm in trouble. And then we landed our first deal in April of 2022. And then luckily it snowballed from there, and the rest is history.
Give us an idea, Dylan. For the record, listeners, I didn't prep Dylan with asking for any sort of data or numbers on himself or the market or anything like that. So we're all shooting from the hip a little bit here with this being a new podcast. Give us an idea, Dylan, what you're 22 to now. How many deals have you been involved in as an investor wholesaler? Give us a better picture of what your activity has looked like in the last 12 months.
Since starting that business, we've done over 300 off-market transactions, most of them being wholesale. And at the beginning, what changed back then is you could realistically sell to hedge funds. There's a couple here that was really easy to sell to. That went away late 2023-ish. And at the beginning, you were selling a lot more to people who wanted to keep properties as rentals, especially small multifamily, 2 to 4 units. Now lately, really this whole past 12 to 18 months, I'm really only exclusively selling to flippers. And I just think that's the nature of the market, interest rates going up, where you can still make the flip numbers work a little bit easier in Cincinnati than you can maybe some of the buy and hold stuff. I'm not saying it can't be done. It's just how the numbers line up with increased median prices and interest rates. One thing where I will say foreclosures are still a good lead source. They've always been up there in the lead source. We track those pretty closely between 4 different counties. They have gradually gone up and up over the past couple of years. And I think that's just a sign of the times.
Those four counties, you're talking about Hamilton, Clermont, Butler, and Warren?
Correct.
Yeah, so the Ohio portion of Greater Cincinnati. Please continue.
I guess not to get on a tangent, but one interesting thing I've noticed lately is a lot of the sellers that are kind of raising their hand that's saying, I'm interested in selling, were the 2021, 2022 buyers, maybe some elevated prices, but they really don't have any equity. And so the only thing you can try to do is you can try to get creative, do a subject to, but I'm not a huge fan of that strategy anyway, but their interest rates are usually pretty good.
You're saying that they don't have equity when they were buying in 2021? I know a lot of properties in Cincinnati have been on that slow and steady path in terms of home value. Can you elaborate more on that? What you're seeing?
I'd say they would have paid retail then, and then now, even a couple of years later, yeah, they might have a little bit of equity, but to make a flipper's numbers work, they don't. You're buying at 60% of ARV in a lot of those instances.
We're talking about someone who bought putting 3.5% down. And yeah, the property has appreciated since then, assuming similar condition or better, but they don't have 30% equity.
Correct.
40.
Yeah.
So that makes sense. Dylan, we know that there are people who are successfully buying rentals off market right now. You're primarily selling to flippers. Is your marketing geographically targeted? What kinds of areas are you marketing to right now?
Good question. And I think I have an answer. So I mostly market to deals that probably would be better for flippers. And that is purely a volume play. There are more houses, single family homes that are eligible for flippers than there are probably for rentals. It's just a numbers game. And I market to all of Hamilton County. I am not picky when it comes to Hamilton County because I have buyers all over. But as far as Butler County, it's the southern portion, all the way over to Hamilton, like the northwest. I'm not going out to Ross or New Miami or any of the stuff that's up there. Warren County, saying where my neck of the woods where I live now. Mason, Loveland, not real. Maybe Franklin's probably the most north that will go. And then Clermont County, we're really just staying on the west side. I think I'm doing actually a deal out right now in Bethel, but that's definitely the farthest east that we will go out. And to your point, like even to my own rental portfolio, out of those 50 units, there hasn't really been a big year versus a small year. They've all been around 10 to 15, 10 to 20 per year. If you look at the data, a lot of it, at least in the off-market business, is what you hunt for, right? Like you can set up direct campaigns to go after 2 to 4 unit properties, which is the bulk of I shouldn't say that anymore. I've traded up recently, but a lot of the acquisition at the beginning was 2 to 4 unit properties. As a caveat, not to rant, but if you add up all the rentals I have owned, it's over 100, but I have not been afraid to sell here and there to trade up to assets that are a little bit bigger that I can take down myself.
So you find deals in all of these counties. Are there any areas or neighborhoods where you're finding more deal flow than others, or are they just all over the place?
On the rental perspective, they're definitely more the west side of town for buyers. And I think that's just a price to income component. Cheviot, Westwood a little bit. Delhi is a big one. Anything in Oak Hill schools is usually pretty sellable. And then on the east side, you can still get stuff in like the Deer Parks, Pleasant Ridge, Evanston, then Avondale too. But like Avondale's kind of synonymous with maybe a little bit lower price, but your income can be pretty high.
Adding on that, Dylan, you've been in this for several years. You've been full time for several years. Are there any parts of town where, based on your marketing, you're surprised at how high or how low your deal flow has been?
I always get calls in bad parts of town because I think people kind of want to get rid of their bad properties. South Fairmont, North Fairmont, East.
But talking specifically about the deals that you're actually doing, when you look at the stuff that you decided to pull the trigger, get it under contract, and then either sell the contract, buy it, sell the property, buy it, keep the property. Are there parts of town where you've seen that you've ended up with a higher or lower deal count than you expected over the last 5 years?
Hamilton was a big surprise. And I think that's because I had a lot of money going into it. So that's Hamilton, Ohio, which is in Butler County, not Hamilton, the county. But especially, so Hamilton really has 3 zip codes, 45011, 013, 015, 013 being the west side of the river. And that has been the ball. Like a lot of people wanted to buy there. They had Spooky Nook going in. They had a whole bunch of other private companies that have really developed that downtown. And then I guess if you're talking Hamilton County specifically, I'd say the deals are a little bit fewer in areas like, I really haven't done a deal in like Hyde Park. I've done a few in Oakley. But you get up against some of those higher price points, it's really hard for those people to take a big haircut on any equity that they may have. Norwood is notorious for getting people, and there's different subsections of Norwood. Slocum, I sold you a deal, and I think it was Westwood, or was it? I know it was on the west
Yes.
side. I don't remember. Yeah. So they're all over, but they are primarily on the west side of town. And then my own rental portfolio is sporadic. It's Deer Park, the city of Wyoming. There's one in Cheviot. There's one out in Batavia, St. Bernard, Delhi. So there have a few, I guess, all around. But yeah, I don't know if I'm answering your question as well as you want, but that's my answer.
No, that makes a lot of sense. When it comes to the flips that you're selling, where are the ARVs coming in on most of these deals? I think the one you sold to me in Westwood had an ARV of 150, 160.
They're usually a little bit higher
Yeah.
than that. And I am purposely staying in that first, like probably 350,000 or less. And really probably around 250,000 or less. I just think there's more of those kind of buyers, especially in the Cincinnati MSA. And honestly, when you get to that little bit higher price point, you need better finishes. You need probably better contracting work. You need a little bit better, higher end deal. That's just not my strong suit. I'll focus on what I'm good at. And I could put in white shaker cabinets, $40 per square foot granite countertops, Amazon poles. It still looks great. Quality's good, but it's not going to be maybe the $60 per square foot quartz that people are getting in other submarkets. And so if you're looking at submarkets of Cincinnati, if I get a deal come across my desk and the ARVs in the 400s, like I'm going to have to get a pretty significant discount, where most flippers will use 70 to 75% of ARV minus repairs. I won't really do that. I'll back into the deal based off what I have to pay a realtor, what I think my holding costs for the loan will be, etc. But if you're getting a higher price point, I'm going to want a bigger spread for the time and energy and risk associated with that.
We're going to pause right here for the Queen City Pulse, your weekly snapshot of what's going on the ground in Cincinnati real estate and around the city. Let's get into it. The Brent Spence Companion Bridge is officially moving. Demolition started at Longworth Hall in Queensgate to clear the path for construction. The full project is a $4.4 billion infrastructure investment connecting Cincinnati and Covington across 8 miles of highway widening. Infrastructure at that scale is a multi-decade demand driver for the surrounding neighborhoods and a signal that the region is finally getting the connectivity upgraded it needed for years. Next up, in Liberty Township, Hills Properties just delivered its first units at Relay 129, a 402-unit community adjacent to Costco. This is Hills' largest Cincinnati project ever, and they already have 75 units pre-leased before many buildings are even complete. While national developers are pulling back on construction starts, Hills is still building, and that's a strong vote of confidence in the Greater Cincinnati submarket. On the University of Cincinnati campus, the $330 million Block 1 and 2 student housing project just topped out its tallest tower at 17 stories. That's 1,310 new beds coming online in fall 2027 on land that sat blighted for 20 years. More students housed on campus means more economic activity flowing through Clifton Heights and the Uptown Corridor. And finally, a macro story worth watching. A new S&P Global report is flagging that small towns betting heavily on data center tax revenue could be taking on real budget risk. Data centers generate concentrated, volatile revenue and may not provide the long-term economic base. Cincinnati's economy is anchored by healthcare, manufacturing, and finance. That diversification will protect against any specialized industry impact. That's your Queen City Pulse. Now back to your regularly scheduled programming.
Instead of asking a question here, Dylan, I'm going to make a statement, and I just want to get your reaction. Feel free to disagree with me. I don't think you will. It's a pretty solid statement, but I'd just love to hear what you have to say feeding off of this. So you said the majority of your deals are coming in with an ARV under 250. You can't build a house for 250 that'll retail for 250 or less right now, which effectively means that houses with an ARV under 250 that are desirable to single family owner occupant buyers, the inventory is capped. You've got a fixed number of those houses that will ever exist because you can't build anymore. Not only that, but to your point, they're really simple to renovate because the expectations of those buyers are lower than buyers at higher price points. So you still need to do good quality work, but it's more affordable materials, it's more affordable contractors, which makes those deals a lot easier to do. And there's a sweet spot there. And I'm talking particularly to people who are outside of the Midwest who really don't understand our price points. There's a sweet spot with smaller, older single family homes where sure you can get yourself in trouble not understanding the implications of older mechanicals, things like that. But the demand for sub 250 houses will continue to rise. The supply is fixed, and it makes for a great place to either get into investing or frankly return to investing when other things aren't going as well for you, or when you know that you need deal flow, because those deals are always going to be there and those properties will continue to appreciate in value because demand is increasing and supply is fixed.
Yeah. And how many 2-1s, 3-1s, 3-1.5s of the one car garage underneath the house are there in Cincinnati? There's a lot.
Six figures, hundreds of thousands of those.
Yeah. And that mold now, I mean, I feel like I'm at a point where if you give me the zip code, square feet, beds, baths, I can probably tell you what the ARV is. And going backtracking, Madisonville was actually a big part, especially 2022. We did a lot of stuff in Madisonville.
That makes sense. Are you seeing that Madisonville deals are working there as well in 2026 as they were 4 years ago?
No. And the reason why I say that is because like you can still support some high ARVs in Madisonville, but it just seems so spotty. Even now, if you would just type in Madisonville and then if you go to for sale, you're going to see similar beds, baths, square feet, off-street parking, proximity to MedPace, all that, and the Ackerman Group's new development down there. And those could be off by hundreds of thousands of dollars. It's really hard to comp inside of Madisonville right now.
You've name dropped 3 neighborhoods where I personally struggle to get ARVs and find comps because they're so block by block, and because there's serious potential on some of those blocks and there are serious red flags on other blocks. So the neighborhoods you've named where I have to pay closer attention myself: Madisonville, Evanston, Avondale. And I'm looping Avondale and North Avondale into kind of the same thing by saying that right now.
I would include Norwood in that too.
Norwood as well. Yes. So a couple of questions. Are there any other neighborhoods or cities in the MSA that you feel like we need to add to this list? Like, listeners, you got to understand it's block by block here. Madisonville, Evanston, Avondale, North Avondale, Norwood to some degree. What other neighborhoods?
Those are the biggest ones to me. I think Reading is another one I'd probably throw in the mix.
That's fair. Yeah. Reading is like Norwood. I wouldn't consider it block by block necessarily, but it's definitely non-homogeneous. I've said this about Westwood as well, that those are neighborhoods where you have, like, in Reading, you have the Bidle district, you have on the hill and in the valley, and you have to understand that there are some pretty sharp lines that when you cross over it, you're just not comparable anymore.
I will throw in St. Bernard, and I am biased. My largest portfolio is in St. Bernard, but they're literally comps, and like for 350, almost 400 grand, a couple of blocks away, that'd be like 200, 175. It's kind of wild.
Yeah. And St. Bernard too is, I feel like they've been working on having a cute small town walkable downtown for 15 years.
Yeah, they're making progress.
They are. That Dairy Queen opened, and I was trying to go there to get a Blizzard, and the line was around the corner. Like there were 25 people at that little walk-up only Dairy Queen, and I thought it was going to close before I could get my ice cream, so I just went to UDF. But yeah, there's some desirability there in St. Bernard specifically because you have the coffee shops, the UDF, you got some restaurants there, some stuff that can be walked to. Dylan, what advice do you have for people, newer investors who are considering deals, even the cookie cutter 3, 1.5, 1,200 square foot single family home, which does exist in every neighborhood that we've talked about? What advice do you have for our listeners on better understanding those deals in those neighborhoods before they buy their first one?
First things first is just know the numbers and underwrite these until something comes up and this pattern recognition kicks in. We're like, I think this is a deal. Because if it is, someone's going to jump on it pretty quickly. And you have to almost be like, okay, and you're going to need to act fast. At those price points, they're still moving quicker. And I have friends all over the country where it might be slower. The spring market's kind of here in Cincinnati and things are still going quickly. Second thing, I'm a biased opinion because almost every deal I do is from my own deal sourcing. So if deals come in from either other wholesalers or agents, I'm like, like I have a negative bias towards that already. But work with an agent that understands investing and can put in the offer same day and can maybe negotiate a little bit on your behalf. And the most importantly, probably has resources to the affordable contractors that we referenced previously.
Are you saying that people should expect to work with a realtor if they're trying to buy off market?
No, I'm saying they won't come across an off-market deal likely on their own without spending some money.
Dylan, can you share some of the latest policy changes in Cincinnati regarding wholesaling, or in Ohio? And that's become a topic.
Yeah, took place, I think it was March 2nd. And it's just a disclosure rule. I think it's SB 155, I think. But essentially you have to disclose that if you will be mass marketing the property, and it has to be signed first before your PSA is signed from the seller, and basically saying, like, we will be advertising this. The biggest thing that I think this touches on is if you are mass marketing the contract for the property itself. If I got a contract and I know I was going to close on it, I don't need that disclosure signed. But if I'm going to mass market it all over social media and Facebook and other Facebook groups around Cincinnati, I definitely would. And there are significant fines. Like I think they can come back for 3x your assignment fee and plus attorney fees. Like, it's not small on what they can do.
I am under contract to buy a deal from a reputable wholesaler that we know, where they had to provide that because I got it. They got it under contract after March 2nd, and I got it under contract from them, of course, after that.
Which actually is a good tidbit. If you are a buyer buying from a wholesaler, you also want to request that they have this documentation, because you could, I don't know the exact legalities, but my lawyer has explained you could also be on the bad end of that deal as the buyer.
I want to give another piece of advice to people buying from wholesalers. If you know that the wholesaler you're buying from is not taking ownership of the property before selling it to you, you need to see their original purchase contract before you sign the assignment agreement. You can't just make assumptions. And the assignment agreement is not designed to be all encompassing. It's just designed to explain that you are taking the place of the buyer on the PSA. None of this is legal advice, by the way. So please don't take this as personalized legal advice coming from me, Ian, or Dylan in this conversation. But the assignment agreement isn't designed to summarize all the terms of the purchase contract. It's just designed to make the end buyer the buyer on the original PSA and explain what changes. A mutual friend of all of ours, they were going to send it to me anyways, but I required that they send me the PSA. They wanted to black out the purchase price. I did make them confirm that their purchase price was below the price I was agreeing to pay, purchase plus assignment, just to make sure. But then I reviewed their entire purchase contract. Again, I've been a real estate professional for a dozen years, but I need to see that original PSA so that I know what I'm signing up for when I become that buyer.
Yeah, I couldn't agree more. Just as hypothetical, let's say their earnest money was $10,000 and now you're the new buyer. No one performs. You'd be on hook for the 10 grand in EMD.
Also, I learned that the wholesaler had given themselves a very generous inspection contingency, which was still going on for another week and a half after I signed the assignment agreement. And that generous inspection contingency became mine. So frankly, I could have terminated the contract unilaterally as the buyer without involving the wholesaler, just by delivering written notice to the seller. And so you
Correct.
wholesalers out there listening, I'm going to find that. And I'm not going to go into the deal intending to exploit it. But dude, you got to know that you're giving me these contingencies when I become the buyer on your contract, because I'm going to know. And you're not going to want your deal to fall apart because your buyer releases your contract because you gave them your generous inspection contingency. Heads up, wholesaler, friend of all of us who will remain unnamed for now.
Yeah. And the landscape definitely, like in wholesaling, has changed, not just from a regulatory perspective, but like it was I don't know, it got very popular, the 2020, 2021, 2022. And now, at least to me, it feels like there's maybe 5 or 6 companies out there that we probably all know, but they run at a very high level. They're very all competent. We all have pretty much the same data. So from my side of things, it is definitely more competitive than it has been sourcing off market deals. And for the audience, like my overhead is close to 15 to 20 grand a month, depending on ad spend. So, and I'm not even close to the largest operation. So if you're a one-off guy, like I'm going to send out some direct mail, be expected. Like my general word of advice is keep at it for a minimum of 3 months. Be prepared to spend 10 to 15 grand that you might not see a return on. And if that's the case, like if you're comfortable with that, then go ahead and do it. Other than that, you might get lucky sending out 500 letters and it might happen, but chances are it won't.
I'd like to do a role play here.
Okay.
Dylan, you are a wholesaler experiencing some success and selling to a diverse buyers list, especially of flippers right now, 2026. And you are a non-local real estate investor who's interested in off-market deal. So what I want to hear between the two of you is, Dylan, what is it that you need to hear from someone in Ian's shoes to get on your buyers list and to be taken seriously by you? And then Ian, you're more experienced and more savvy than most people in quote unquote your shoes in this role play. But give us an idea of how you can be answering these questions from Dylan in a way that is going to get our listeners on his buyers list and the buyers list of the other serious wholesalers, direct to seller marketers that have solid off market deals.
First question is always, have you done deals here already?
Am I role playing a new person or experienced? What do you want? Experienced?
No, let's make it a little tricky. And let's assume that this is someone who is listening to this podcast because they're trying to break into the Cincinnati market. So let me jump in here and just say, for the sake of the role play, Ian hasn't done a deal in Cincinnati yet, but he's done one in his local market. So what can he do to get in front of your deals, Dylan?
Dylan, thanks for sharing the fourplex. Really interested. I've bought 2 duplexes over in my local market and would like to expand into Cincinnati, Ohio.
The follow-up question would be like, great, Ian, thanks. Nice to meet you. What kind of financing are you going to be using for the acquisition?
Yeah.
Or are you using financing or are you cash?
I will be a cash buyer.
Great. For the audience, someone who is a cash buyer, even if that's their own personal lines of credit, trumps over someone who has to go hard money or even worse, a traditional loan. Okay, great. Have you run the numbers on the property yourself yet? Did you see what I sent out to everybody?
Yeah, I saw. Thanks for sending over the rent roll in T12. Had a question on the utility spend. It seems like it's owner paid heat, but it seems like it's a little bit high. Other than that, no other questions on the property.
We would make sure that and I'm backtracking, we would make sure we're aligned on the asking price. Because and what do you think ARV is? What do you think repairs are? And I'll usually ask my buyers this so we could come to some kind of mutual term. What kind of financing? And then the last thing is timeline. How quickly can you do this? I have to sell this contract by the end of the month, which is in 2 weeks. And if you tell me, oh, I need 3 weeks to get my financing in order, like, sorry, buddy, like we'll hit you on the next one. And if you are brand new, let's say it's A and B, I have the same offer from 2 different people, but someone I know has bought before from me, they're going to get that. But if you could come in maybe a couple grand higher, okay, let's talk. And unfortunately, that's just the nature of the business sometimes. Proof of funds is a big one too that you can send.
So if someone is going to need financing because they can't put down the entire purchase price, let's call it between 100 and 150. If you're a cash buyer, you've got 100 to 150 that you can deploy in the next week. If they don't have that, are there certain kinds of financing or certain lenders that you're going to look at more favorably?
He got interviewed last week, I think. I use Sharper Capital a lot. I refer a lot of people also to them. And that's not just a plug like from I get any affiliation. They've been great to work with and they've financed some of my own acquisitions. There are a handful, I can name drop them. There are a handful of hard money lenders here locally. Sharper being one, M&M being another, Annex being another. All have done deals for me where I can make a warm introduction that says, hey, I have this buyer. They need financing. Here you go. And a lot of times like those things will work out. And for that reason, I have confidence that the deal will get done from a financing side based on my relationship with those lenders.
So you mentioned that 4 years ago, the buyer pool was different. There were more institutional buyers or different groups. How are the conversations changing with what we just role played as a result of even just the market, the different types of buyers? How are your conversations going with as you're trying to find a buyer for
Well, I'll tell you one thing. Sellers, historically, they didn't know what wholesaling was. But now everyone you talk to has almost already talked to somebody else. And so the conversations are a little bit different. It's almost, hey, I know you've probably talked to X 3 or 4 different companies just like mine, but here's why we're different. But I do emphasize the fact that I'm local. They'll be either meeting me or my acquisitions guy at the property. And sometimes that plays favorably if people want to sell to someone who's local. I guess the sellers kind of all know what this is. And a lot of them feel like I get offers weekly for my property. So why would I sell it at such a discount? It can be a headwind at times. And then conversation with buyers, it's been relationships I've built up over the years. And to be honest, like I'm different from most wholesalers, which mass market all their stuff. Like I don't post a lot of deals on Facebook Marketplace or cold email a lot of my deals out. I probably have 15 to 20 people that get the first look at a lot of stuff. And I know that's hard for a lot of newbie people trying to come in. But at this point in my business, it's nice knowing that because when you're a wholesaler and someone says they buy it and it's a day before closing and they back out, that's the worst possible thing that can happen. So relying on the people that I know and trust and have bought deals from me before is now my go-to strategy. We do some things with data too, to answer your question. So like I will go into the auditor site, pull the previous month's data of who's transacted, which ones are an LLC. Do I recognize those LLC names? How other much properties do they own? And you can kind of get, like Hamilton County, honestly, is a great data source for finding out who's buying and who's selling.
Thinking about the people who are actually buying your deals, Dylan, are there any commonalities amongst the people who are willing to pay the most or give you the most compelling offer to purchase?
Usually they're experienced. Usually the pricing helps. There's margin for everybody. They have liquidity. I mean, they just have ample cash and they can move quick because a lot of these things will move in 30 days or less. And so being able to have the resources to take on a project at any level. I will actually, now that you brought this up, I feel like a lot of the ones as of late have been large rehabs, like 6-figure plus rehabs. So you almost need like an experienced person to take that on because if you're a newbie, I would not take that on as your first rehab. That only just popped in my head as you asked the question. So
Dylan, I'm going to make another statement here. I just want to get your response and then we'll head to the close of this episode. One of the reasons behind Ian and me making this podcast, of course, is self-promotion. I provide a lot of services that real estate investors need and the kinds of people who ought to be listening to a show like this. And so we're trying to add value to them. A point beyond that, though, is that I believe we've come to a time where you need an expert operator. You need some expertise in order to be able to invest successfully in 2026. I want to point out a couple of things that you said here. One of them is there are a lot more professional direct-to-seller marketers, wholesalers out there than there used to be. You're talking about a $10,000 to $15,000 ad spend a month. It's 120 to 180 grand a year. That's a white collar 6-figure salary that you're spending on your postcards and your SEO and everything else. That's not very mom and popable anymore. It's a lot harder to be an amateur, get a list of 200, send some postcards and see what happens. That doesn't work nearly as well as it did 2 years ago, much less 10 years ago. And so in order to succeed in this space of wholesaling, you have to professionalize. You need to be an expert like Dylan anybody can get lucky. You can send one piece of mail and get a call back from a seller who's willing to take your price. But most of the time when you're marketing to homeowners, you're not the first person that they've talked to. It's a different conversation now because there are so many more players in the space who are good at what they do. You really need expertise or an expert operator on your side to be able to invest successfully in 2026 in Greater Cincinnati.
Yeah, I would 100% agree with that. And having just the resources from all aspects, I think people underplay not only the contractors. If you're out of state, a good PM, which I mean, not as a shameless plug. As I was growing my wholesaling business, Slocum ran a large portion of my portfolio so I could grow the wholesaling business. It's come to a time now where I have an assistant, so I took it back, but no qualms with TLP and the management side of things.
Yeah. Dylan, last question we ask every guest. What are your Cincinnati hidden gems? Doesn't have to be real estate specific. Most of the people who live here, almost everyone who doesn't, what are your favorite things in Cincinnati that they don't know about?
It's funny because I got converted, right? So I eat the La Rosas, I eat the Skyline.
I draw the line at La Rosas. I've found my way at Skyline. I'll eat La Rosas, but there's just like, how much sugar can you put in the tomato sauce?
Totally. Raiders, obviously. So all the Cincinnati staples. And I was a Reds fan coming here. More like I don't know if it's hole in the wall, but Arthur's Cafe in Hyde Park Square has like the best burgers and a good atmosphere in the summertime.
Best fried cheese in the city.
Yeah, like
easily.
I love that place. So if like I'm ever down in that area, which I'm not down there as frequently anymore, I will try to stop in. I like that place.
I moved to Hyde Park when Arthur's Burger Madness was like $6.99 Monday through Wednesday.
Oh man, I would have lived
for
there.
unlimited toppings on a burger with fries. Yeah, no, I'm showing my age.
Yeah, no, that's
awesome.
I'll keep it there if that's okay.
All good. Dylan, thank you, listeners, as well. Thank you for tuning in. If you've gained value from this episode, please do subscribe to our show. Leave us a 5-star review. Share this episode with a friend that you know that we can add value to through our conversation today about what wholesaling looks like in 2026 in Greater Cincinnati, but also what buying from wholesalers looks like. Thank you, and we will see you next week.
See ya.